Hello and welcome to our Financial Econometrics Time Series project. This project is by Kevin Benavente, Maddie Brenner, and Jonah Kral. This presentation will go through our introduction, exploratory data analysis, model description, model performance, predictions, forecast, and account balances. For the project, we were given a dataset featuring a portfolio of 1,043 loans. The dataset showed the account balances for each individual loan at a monthly frequency for 4 years. Our task was to use this historical data to forecast an aggregated figure of the total balance for all these loans for the following 12-month period, July 2022 to June 2023. After researching and testing models, which we'll discuss throughout the presentation, we chose to utilize the seasonal autoregressive integrated moving average with exogenous regressors model, also known as SARIMAX. Before we built out our model, it was critical to understand the loan data through the process of exploratory data analysis, which for us included studying our given dataset, researching the effects of exogenous variables on loan balances, as well as examining the data for the presence of seasonality and trends. We began our exploratory analysis by brainstorming which economic indicators would likely be exogenous regressors, meaning which outside forces would likely have effects on the movement on the balances of our loans. We leveraged public time series data from FRED as our primary data source and looked into variables such as different interest rates, inflation, the stock market, and government stimulus measures. Based on macroeconomic theory, when interest rates are low, we would expect the demand for funds to increase as people take advantage of the lower cost of borrowing. We took this a step further and created a time series of the yield curve slope based on the 3-month T-bill subtracted from the 10-year Treasury rate. We expect this slope to be explanatory of loan balances, as its level, and whether or not it's inverted, often reflect general economic and credit conditions. On the graph at the right, we see the similar movements between the yield slope and the log aggregated loans. To begin understanding which exogenous regressors would be most effective in our forecast, we created a correlation matrix. Our goal was to select exogenous variables which exhibited relatively low levels of correlation to each other. For example, we wouldn't be necessary to include both the S&P 500 and the Dow Jones. We also wanted the model to have a strong fit, so we were looking for variables which had a high correlation to the dependent variable. For these reasons, along with much fit testing later in the model, we chose the yield slope and the S&P 500 to move forward with as our exogenous regressors. When we tried adding more regressors, we found the fit of our model wasn't impacted significantly. Since the loan portfolio may take time to react to changes in the economy, we tested a 1 to 12 month lag of variables and their correlation with the loan portfolio balances. The exogenous variables we selected, the yield curve slope and the S&P, had an optimal lag of 0 months when looking at their correlation levels with the dependent variable. So therefore, it was not necessary to lag our exogenous variables in the model.
At this point, we were then ready to begin choosing a model. Based on our analysis of the autocorrelation function and the partial autocorrelation function, an AR model appeared to be a good fit for our aggregate loan portfolio data. The ACF chart showed a geometrically declining pattern, which is a characteristic of an autoregressive process. Additionally, the PACF chart revealed significant autocorrelation at lag 1, but becomes insignificant after lag 2. With this knowledge that an autoregressive model would be a strong fit, we explored extensions to it, such as an ARIMA model, which includes 3 main components. Taking a closer look at the ARIMA model, we see that it's broken down into 3 parts: the AR, the I, and the MA. First, the autoregressive captures the effects that past or lagged observations have on the current observation. This is important to our model in that we need to know how past movements in the loan balances will impact the future behaviors. The I integrated part refers to the differencing of time series data to make it stationary, so the mean and all the other statistical properties remain the same over time. This component helps to remove trends and is necessary for us to accurately forecast the loan balances. And lastly, the MA, or the moving average, captures the effect of past residual errors on the current data, such as random shocks. The SARIMAX model incorporates all of these necessary components of the ARIMA model, but it extends to include seasonality and exogenous variables in its predictions of the dependent variable. As we discussed in our exploratory data analysis, loan growth patterns are impacted by the economic environment. Therefore, we believe it's necessary to include economic variables as exogenous regressors in our model. So at long last, we were finally ready to begin creating our model. And as you can see here, our model had 5 main components: the trend, the non-seasonal AR, the non-seasonal MA, the exogenous variables, and the error. But then we had to add differencing and account for yearly seasonality, and so we got our second equation. And so to fully expand our equation for clarity, you can find it here at the bottom. But before we could do any type of predicting or forecasting, we knew that we still needed to test for the presence of seasonality. In order to do this, we used Python's seasonal decompose function to graph the logged loan data by its seasonal, trend, and residual components. And as you can see, for a 12-month frequency, the seasonal component ranged from 0.05 to negative 0.05. Meaning that seasonality represents a log difference of around plus or minus 5% of the mean value of the total loan balance. This once again proved that it was essential for us to use the SARIMAX model.
So to evaluate the in-sample performance of the SARIMAX model, we began generating predictions starting 12 months after the beginning of the dataset, so beginning in 2019. This delay ensured that the model had enough historical data to account for yearly seasonality patterns, which we decided to model. We then applied dynamic predictions to simulate the real-world out-of-sample forecasting scenarios, which is the ultimate objective of this project. So we do that over 2 horizons. So we first begin the dynamic forecast after 1 year. So on the left-hand side, the dynamic forecasting begins after the vertical dotted red line. So this begins in August 2020. Up until that point, the model relies on actual observations and then uses predicted values to forecast the subsequent months. And on the right-hand side, we conduct the same exercise, but the dynamic forecast now begins 2 years after our predictions begin. So extending the horizon, we began a second dynamic prediction starting in August 2021. And some overall trends that we observed: 1, the observation values generally fell within our 95% confidence bounds. So we're pretty comfortable with the fit. And also our model directionally matched the trend of the actual data. So after cross-validating and simulating the out-of-sample forecast with the dynamic forecasting, we were comfortable moving forward with the true out-of-sample forecasting exercise. The last chart here is just showing how we fit our framework on the entire sample data set. So when we leverage the full sample period, we don't implement any dynamic forecasting, we achieved a mean absolute error of 7.3%. So being under 10%, we were pretty comfortable with this model fit and pretty comfortable moving forward with the forecasting. Here we're displaying the regression output from our headline SARIMAX specification, where we use yield slope, S&P 500, an AR1 term, a moving average term, and again, accounting for yearly seasonality in the data. So what we generally find is that we demonstrate strong overall fit, which is evidenced by negative AIC and BIC values. These metrics indicate a balance between model complexity and explanatory power, which confirms the model's capacity to represent data. One observation, though, is we notice that across our coefficients, we don't find any significance. And this is due to the fact that we don't have that large of a data set, so we're only leveraging 4 years of data. Ideally, if we were conducting a rigorous forecasting approach, we would want to leverage several years of data, several decades, 40, 50 years of data, which would inflate significance likely. And it's also could be due to the fact that we're specifying our dependent variable as the log differences, whereas our explanatory variables, S&P 500 and yield slope, are not in log levels. So moving on to the forecasting, our SARIMAX model predicts a steady decline in the total loan balance of the portfolio over our forecast window from July of 2022 to June of 2023. And this decline generally aligns with our chosen exogenous variables. The yield curve was inverted for most of this forecast period, which is widely recognized as an indicator of recession and pessimistic economic sentiment. And the S&P 500 was largely flat during this 12-month window as well, which kind of signifies a lack of strong economic growth or strong investor sentiment. So given these conditions, a general decline in investment and loan issuances is expected, and we believe that our model accurately portrays this anticipated decline, which reinforces its value as a tool for forecasting portfolio behavior during different economic regimes.
As it was our goal to produce a forecast of the total balance for the next 12 months using the model, we decided to include those balances here.